Thank you. Can you guys hear me okay? Perfect. Great. Thank you. So yeah, it is introduced. I have a background primarily in energy. I've spent my whole career in oil and gas, starting with Exxon as a petroleum engineer, really working upstream facilities, Gulf of Mexico, onshore, Alabama, Louisiana, Texas. Pivoted over to the financial side of the business. I was at Credit Suisse for a few years. I did all of their pipelines and MLP analysis, and then switched over to the buy side. Did that with several different firms for the last two, running all the global listed infrastructure investments for Brookfield. And then finally, spent the last four at Citadel, where we covered all of the oil and gas companies, oil field service companies, you name it, up and down the value chain, primarily in the US and Canada. So decided that that was not really the path for me going forward. Wanted to do something more, I don't want to say meaningful in my life, but something that had a real impact on the earth and how I was going to leave it. One of the things that I really knew a lot about is I had a little bit of a background at Exxon. I did a lot of sour gas treating. So that is removing CO2 and H2S from natural gas, and understood how difficult that is, and just looked at, really became interested, as you guys know, back in 2020, 21, a lot of corporates made net zero pledges. I looked at that and said, well, that's going to be pretty difficult to do with base operations over, the time period that they're looking at, most likely over several capital cycles. I think it's doable. But for the most part, I thought that was going to be a tall order over the next, 10 to 15 years. When I looked at the potential carbon offsets and started becoming interested in that market, I realized that there was actually a pretty tremendous opportunity that really nobody was addressing. And I think it's primarily due to the fact that there's just not that many people are aware about it. And we are starting to hear, like this conference today, talk a little bit more talk about it. And there was a paper written that really kind of crystallized that funding in the Biden administration, talking about repurposing oil field workers to go and plug and abandon some of these orphan wells. But the genesis was really just to take an incentive and really stop wells from becoming orphaned and abandoned. So the next slide, can you guys see the slides or no? Anyone? Okay. Okay, it's really just me now. We can go to the slides if we can, or share screen. Go. Okay, we can see that now. Okay, great. So the overall purpose of us is to primarily stop carbon and methane from ever entering the atmosphere. And we're doing this by providing a framework to shut down these wells. So the problem, as you guys have alluded to a little bit earlier today, is pretty significant. And we think there are about 3 million wells in the US, and only about 1 million produce anything. So we think the 2 million wells out there that are really not producing are primarily orphaned and abandoned wells, or they're operating very intermittently by a corporate that's trying to push out those liabilities. Out of the 1 million that are producing, we think there are only about 250,000 that are actually giving us almost all of our production, about 95%. So there's another 750,000 wells that are giving us very little production, about 5% of our total, but they are responsible for the majority of fugitive methane emissions. So what we're trying to do is stop that last sale of that dark blue pie of 750,000 wells to the least capable operator who never has an intention of plugging and abandoning those wells, and stop it from becoming in that pile of the gray wells that are going to eventually leak methane potentially for decades. And so we think by doing this, we can lock in about 20 million tons of methane and several billion tons of CO2 over their lifetime. And what we're defining a lifetime is the next 10 years of production. But we know that most of these low producing wells will continue to produce for decades if we don't do anything about it. So within the climate circles, there's been a lot of talk of reforestation and nature-based solutions. And the one thing that we always viewed is that the oil and gas industry is primarily responsible for the majority of emissions. Now they're primarily scope 3, but at the end of the day, the majority of CO2 comes out of automobile tailpipes, diesels, trains, tractors, everything that runs on fuel, and to a lesser extent, plastics. And most efforts have been around reforestation. But because of the scale of the industry, shutting down these wells has the equivalent impact of sequestering the same size forest as all of Africa and all of China combined. So if we can plug these 750,000 wells, we'll stop them from ever becoming more of a problem for the state, and we'll have a dramatic impact on the climate. So how do we do this? What's the incentive? You know, the good news is that these wells produce very little. And what I mean by that, you know, you're talking in our pilot wells about 5 barrels a day. So very little in the way of revenues or net income. Thus why they're primarily the major sources of fugitive methane emissions per Environmental Defense Fund and work we've done. It's simple. They're producing very little revenues, so you have very little cash flow to be able to properly maintain. Therefore, you start having leaking valves, leaking thief hatches, all the facilities surrounding those wells start to leak. And once they're abandoned, you still have a water column on top of the reservoir. So say you have 200 PSI of like pressure facing the reservoir. So the gas will migrate over, and then kind of belch up. And then you'll have a methane emission from an orphan well. But with a low producer, it's continuously shooting up. So it's a much bigger problem than even the orphan wells would be, even though they're more than 2 times the size. So they're not making much money. The only reason that they live on is to get a little bit of cash flow, but more importantly is to defer that, you know, $50,000 to $100,000 abandonment liability. So if we can overcome those 2 things, an operator is perfectly happy to plug and abandon the well and walk away from it. So in the case of our pilot well, that operator could have sold those wells for, call it $20,000, $25,000. But now we have to overcome the price of the sale, the 25,000 plus the 100,000. So the operator's net kind of worse off by 125,000. So we have to get them close to that. And each one of these wells has about, call it 6,000 tons of avoided emissions. And those really come from 2 sources. The first is the oil that's remaining in the ground. And the second is from the methane that's not leaking. Now, the oil left in the ground, I think, is interesting because this is a permanent solution. And what do I mean by permanent? Well, we're going to leave, call it 10,000 barrels of reserves in the ground. These are the cheapest barrels you could ever put on the market because all you have to do is overcome the marginal cost of production. So very low. When you leave those stranded and you plug and abandon, you would have to go spend, call it $10 million to go access those reserves. So just to be able to break even before time value of money, before operating costs, before royalty interest, before taxes, you would need $1,000 a barrel. So effectively locks those reserves in the ground, never to be touched again. And we calculate the area of which we've locked in the ground. And therefore we know the volume and the reserves that are left in the ground, as well as where a well would need to be drilled to go access any of those in the future. So nobody's going to drill into a pressure sink. Even if you could say, oh, what about runaway inflation? What if oil went to $1,000 a barrel? That's fine. But plugging in abandonment costs or drilling of the new well isn't going to be $10 million. It's going to be something far greater and keep up with inflation. So think of it as $1,000 a barrel, more or less a real number. So we then, once we shut it down, we get the permit, we go through all of our methodology, which we developed, and then we put everything that you would need to understand that this well was completed and plugged and abandoned. And we put that all on chain. And then we issue a NFT for that credit. And then we can burn that credit and create a fungible token that we're going to talk about here in a little bit. So this is a process a little bit more defined, but some of the motor or what we do is that we find the wells that are most impactful. And what are those? Those are wells that are producing, call it 10 to 2 barrels a day, that have a high gas component, that are over 10 years old. We go and work with the operator once they're identified and convince them that this is a good idea. And so far, when we talk to companies, if they believe that they can get the majority of their money back or even close to it for doing this rather than selling it, it's a better outcome for them, because now they have the permit in their name, as well as that ability to say that they've mitigated the risk to the best of their ability. Because we said earlier, like selling it down the line, that entity becomes bankrupt. Does it ever become your liability again as an ongoing entity? So then we go and actually, we've identified it. We've worked with the operator who's amenable to it. We work with them to shut down the well. We do that per all state regulations. We also work with the landowner to make sure that either there's alternative uses or it's brought back to the natural state. And the nice thing with our credit that's a little bit different is the majority of forestry-based credits don't come with any type of certificate of completion from any type of entity other than the project verifiers. We get a permit from the state verifying that the work was done to their standards. We then take our calculations and have those checked against a reserves auditor. We have drone imagery and data that will tell us what the methane leaks were before and after. We also know how much oil cut was left in the ground and can calculate with precision, how much was oil, how much was gas through gas chromatograph sampling. And once we have all that, we put it on chain, and that provides really two different things. It's an immutable record of creation of any type of trading, as well as any type of retirement. And it provides transparency to anybody who's an interested party to go look at that. So our Web 2 interface with Web 3, any interested party, whether that's an NGO, whether that's the SEC, whether that's a customer, a supplier, whatever, let's say corporate A, I don't know, American Airlines bought 10,000 tons from us. Any interested party would be able to go on our web portal, find out the exact wells that were shut in, our calculations, the permit, all the data that one would need to feel good that this well, the work was actually done and our calculations are in the ballpark. Now, people could argue with us about additionality. Well, I think additionality is pretty clear cut, but as far as leakage, just say, well, if that well was shut down, are they just going to use money and drill another one? Which there are plenty of academic studies that say that's not true. We think it's about 50%. So if we shut in 1,000 barrels, we only assume that 500 are going to be permanently shut in, and the other 500 are going to pop up somewhere else, whether it's in the US or somewhere internationally. And by creating a token for these, a fungible token, we hope to create a real market for this type of process. So our next slide is opportunity and scale, and what we think we can rationally do in the near term is, we're finishing up, we're done this year, we're going to put it all on chain, 2 wells in Montana. We have another 100 wells identified, which is 500,000 tons that we hope to do in 23. And we think, an early run rate can be over 1,000 wells a year, which can be 5 million tons. We think this is going to be valuable for corporates because, as I said earlier, everybody's been making climate neutral pledges. We think that their base operations are going to be very difficult to lend them to achieving that. And therefore, they're going to have to kind of plug the hole with carbon credits. And so they should be able to utilize these in a quick and inexpensive manner. Forestry credits are typically, call it $20 a ton and creeping higher. And then really you don't have much else in your arsenal that you can purchase other than extremely expensive direct air capture, which I would argue direct air capture is actually net carbon negative because the incremental amount of energy that one needs to pick CO2 out of the air requires it to have dedicated wind or solar farms or some sort of renewable. But those resources are just being utilized on, I think, kind of a wasteful activity where it could be further supplanting coal or natural gas fired generation elsewhere in the US. And those price points are very expensive at call it $1,000 a ton. There's also some things called biochar and others, but you're starting to get in the hundreds of dollars price point. So we believe that having billions of tons at companies' disposal in a relatively short period of time at $30 a ton is going to be pretty valuable. So this is our hope, but we think we can do a lot better. And, we think that we have a token which is going to be differentiated because each well is unique, but we think it can lend itself well to a very fungible market. And once you have that and people can feel good about the currency, then I think it can really take off. And under our process, we never end up doing more than 1% of the wells. And you have to remember, if there's 10,000 wells that are drilled every year in the US, those wells that were drilled, call it in 2015, 2014, and the boom times of shale are aging into our process now. And so that 750,000 is going to grow. And we're trying to prevent that list from jumping over to those orphaned and abandoned wells. Where we're at now at the company, we closed a seed round at a good valuation. We're fully funded. We're building all of our tech, our Web 2, Web 3. So we're putting everything on chain on our 2 pilot projects right now, and we're off to the races. Here's our team as you can peruse through. There are 6 of us plus a 7th who's not on here that's a new recent hire, plus some advisors that are all pretty well connected into the industry. And a majority of the team all came from a private equity backed company called Bruin, who is a big Bakken operator. And so we are selling our tokens now. We're going to do an ICO in the early part of next year. And we think that there's a pretty good groundswell movement where, even if corporate buyers are a little slow to the table as that sales cycle is pretty long, there's a lot of buzz about in the crypto world, in the crypto community, that we have an actual token that's backed by something of real tangible value. And you really just haven't seen that, whether it's like Dogecoin or really anything. I mean, Ethereum and XRP and some others have utility, but they're not actually really tied to an asset. In the real world, the most assets that you see are NFTs, which are, digitalized works of art. So finally, this is our pilot project in Montana. You know, the 2 wells, you can see the production history and then the assumed production curve. And, you know, we think that these wells would have been sold and operated for decades longer. We're only crediting the first 10 years or down to a barrel a day for our methodology. But we think that that is representative because there's hundreds of thousands of wells in the US that are producing a barrel a day or lower. So we feel pretty confident that if we're taking it to 1 barrel a day, that's being conservative and how much carbon you're really leaving in the ground. So that's really all I had as far as prepared slides. Maybe I'll just close the screen sharing and open it up for questions if anybody has any.
Yeah, Sam, thank you so much for joining us, and don't miss the next flight if on our behalf. But we have a couple questions here. Do you have a hard time you need to be off by?
No, I switched it to a flight a little bit later, so I'm good.
All right, great. All right, well then, first of all, yeah, thank you. I mean, I speak highly of this, of your product for the audience's edification. I was in Houston and Dallas last week, meeting with a number of different commodities traders in the LNG and natural gas space, and 3 different people, consultant and two industry stakeholders brought this up of their own accord. So it's getting buzz and it's getting interest. I think the ability to offset any kind of cost of retirement, the business model makes sense. My first question, you're talking about the divestiture, and that's obviously a trend that happens all the time, whether it's Aera in California, in Texas, every basin, it's PDP investing is very well known. That being said, a lot of the majors are getting more pushback from the community after commencing those sales, like EQT to Diversified, for instance, or Exxon and Shell to the German entity that now runs Aera. I was wondering, have you guys thought about a way where you could bundle those credits in a way and include them in the sale? Like whether it be tied to ESG or tied to something where it's like, okay, rather than, EQT selling these low producing wells, trying to find a desperate buyer for these low producing wells, they could sell this as an opportunity as it relates to your credit. Be like, look, we have this many marginal wells. We're in the process of shutting them in and plugging them and receiving a credit, and then monetizing that credit and divesting that rather than divesting what would otherwise be seen as kind of a liability unless you're have a higher appetite for risk.
Right. Yeah, no, that's a great idea. And I think as the market develops for our credit, that kind of opens up the playbook to do other stuff. Now, when some companies have actually sold small packages of wells, we've actually bid in credits to see if companies would be interested in that. But, they want to see some value in some real sales. But I think once we do that and establish a real price for carbon, you're basically swapping carbon credits or carbon price for oil price. And, the nice thing about these, when they're really low producers like this, even if the price spikes from 100 to 150, it doesn't change the economics that much because it's primarily driven by the plug and abandonment liability and not the future cash flows of these wells.
Which would make it even more likely, right, that they'd want to transact with your credit?
Yeah.
And I also separately, I agree with your macro take that for the most part, many of these operators have kind of overstated and overhyped their ability to offset their emissions, whether it's a non-oil and gas operator or it's Bank of America. You brought up that these kinds of entities will need to fill that hole. I'm not, I guess maybe this is a lack of familiarity on my part about the carbon credit market. But what exactly does that look like? So let's say I went for Google and I need to have X amount of offset and I'm going to miss it by 20%. And like that comes up on Q3. And so then maybe I'm looking for a carbon credit from y'all, which is half or 70% less than kind of what are often these like fraudulent credits from, fake reforestation efforts in Brazil. How does that exactly look? Does that come up like right before they report earnings? How does that trade?
No, so it's at this point, there's really been nothing other than the company's kind of good faith efforts to report on this. With the new SEC disclosures that we hope to get at least a look at, hopefully by the end of the year, anybody who's made a climate pledge is going to have to disclose it, more of a roadmap and how they're going to get there. So we think that's going to open up things a little bit where the companies are going to have to say, this is where I'm procuring my credits. And I think the SEC might become a little more interested in some of the standard kind of verifiers and what they know and what they don't know to try to stop some of that fraudulent disclosure. The way it works right now is the big guys who have been doing this for a while, the Microsofts, the Metas, the Googles, the Salesforce, they all have dedicated teams, and these teams work with project developers, and it's bilateral sales agreements. They basically bankroll and give the upfront financing through a contract. Think of like an LNG terminal, like you have all the offtake agreements, so then the financing comes into place and they build it. It's a similar way with all these bigger projects. The problem is if Google buys this, say a reforestation project wherever, Peru or something, then those credits, the project gets completed, the tokens or the credits get issued, and they're held on their balance sheet until retirement. So the kind of third party market for these is pretty light. And the majority of the credits are kind of the ones of lowest quality that are going to change hands. So what we're trying to do is create a market for credits that are of high quality because we can generate a significant amount relatively quickly and be able to, I mean, you want speculators, right? I kind of think of it as like right now, it's kind of like an IPO of a stock and they give all the stock to Fidelity and Capital Group and they hold it forever. And you really need speculators. You need the hedge fund kind of flipper desks in there. You need some people to be able to really set a price. And so that creates, you know, a more balanced book. So we hope to do the same with carbon credits because there's a lot of different new platforms out there for trading. But the problem is the same for every one of them is there's just a lack of supply.
Makes sense. And then transparency efforts that you have built into your system. I think you seem to be addressing kind of dissidents before they're there, which I don't think is ever a bad idea. But it reminded me of, I'm not sure if you saw Hindenburg's most recent report on the bio pellets burned. I can't remember if they're sourced in Georgia and burnt in the United Kingdom or also burnt in the United States. And Hindenburg, they went into the actual underlying data and used geospatial GPS data to find which forests were being cleared and how, and you know, I think unveiled something that I would expect might be much more common in this space as we get deeper into it. I think our presentation forthcoming after lunch about fraud in the RIN sector kind of speaks to that, speaks to some of the issues that can happen, kind of new frontiers, these new markets. So when you're talking about the database, you're talking about registry. I mean, that's all hosted by you all, and that's something that, you know, I mean,
yeah, so that's the beauty of blockchain is it's not really hosted by us. We put it on chain, but once it's out there, it's hosted by every node and every computer that's working on that chain. So it could be hundreds, could be millions of computers. So instead of us just having it on our computer or on our AWS server, it's on a lot of them, which makes it immutable. Because if I wanted to go delete the data, well, too bad. There's 1,000 other people that have that exact same set of data. And next time there's a transaction on the block, it would say, oh, well, you're wrong because these 999 others are right and they voted against you. So putting that all on chain really provides assurance that nobody can mess with it in the future. And putting all the data on chain is actually very new, but that provides assurance that all the documentation will never go away. It'll kind of live forever. And because we're using an ERC20 standard, which is an Ethereum standard, even if Celo, which we think is the most amazing blockchain, that's the first carbon negative chain, and really I think trying to do a lot of good in the world by really working it through cell phones to kind of bring the bottom billion out of poverty and them be able to bank and do all the stuff that we in first world take for granted, utilizing their smartphones. But even if that chain ceases to exist, which I don't think it will, but there's so much interoperability between that chain, as well as all of the other potential tokens or any type of marketplaces out there. I mean, there's a lot of money thrown at the markets. Whether you talk about like Expansive or Flow or some of these others trying to develop marketplaces, you're talking close to $1 billion committed from venture capital firms. But like I said earlier, they all don't have the supply. We don't know who's going to be that eventual winner, but we want our supply to be able to access and interface with anybody because we're passionate about really just fixing this problem in particular. I guess we're quasi a registry, but it's not really a registry in that we're holding the data on our servers. It's really out there for everybody to see and view at all times.
Which, yeah, I think is another aspect that makes your product novel. I mean, I spent a lot of last week listening to the price reporting agencies go on and on and on about how they maintain their own proprietary sets of an index, and I think it's very very cool and admirable that you're kind of putting that on its head. So I just have one last question I got from the audience. When you model out, so you're with those pilot wells, I think you said you modeled out 10 years of production. And, if you're a more zealous producer, like our friends Diversified, we talk about, you'd model out 70 years. If you're another company, who knows? Everybody's got their different models for different reasons. Huge demand for your product as commodity prices come down, as a lot of these guys with their marginal production, the $3,000 or $1,000 a month to run it, now they're starting to run a loss. The only thing the question about that we got is, so if commodity prices come down and if a part of your credit is monetized, so to speak, or based off of the lifeline, the timeline, the horizon of future production, would all of that need to be amended down? So it's like, okay, now, we're pricing those 10 years of production off of $80 WTI, and now we're at 30. Because I could see that kind of eating itself as far as the value proposition.
Right. And we had to think a lot about this because we didn't want to have to change the credits every time the oil price deck changed, kind of similar to, a PV10 or a reserves audit. So the way we handled it is said, look, we'll take up to 10 years, and that's really more trying to match nature-based solutions, but then also having to cut off of 1 barrel a day. And like I said, there's hundreds of thousands of wells that produce 1 barrel a day. So we know that in almost every basin in America, there are people that make economic decisions to continue to operate. And that's been the case, whether it was, April of 2020 or any other price regime, the 90s, when oil was down to $10 a barrel, that is held true. So we think that there's enough evidence that says we don't have to try to calculate what a rational actor would do. We have evidence from the past that shows that they'll continue to operate past 1 barrel a day with almost certainty. And it makes sense just because even if you're losing a little bit of money, if you can kind of hide it on a field level basis, or you just can avoid that $50,000 to $100,000, you'll produce it for a couple of days, shut it in, produce it for a little bit, and you'll kind of drag it on as long as possible, because the worst case for you, especially if you're a smaller operator, is you just don't have that type of checkbook to be able to go properly plug that well today. So even if it is losing money, you're highly incentivized to keep it going. And what will typically happen is you keep selling it further and further down the food chain. So you basically just give it away to somebody who's going to milk it for as much as they can until there's some sort of catastrophic failure, and then they're going to walk away from it. And that's we think it's kind of self-evident with there being almost 2 million of these in the US.
Right. No, that makes sense. And yeah, thank you for reminding me about the barrel a day. You did get to that in part. Okay, very, very helpful. Sam, I'm so sorry about the travel snafu, but your
No
stoicism,
worries.
I'm taking notes about the stuff. I'm like, when I have a weather delay, I somehow take it personally. So good for you. And we really, really appreciate you joining us, and hope you and your son make it to DC within, forthwith.
Yeah, thanks. I really appreciate the time and all the support. And like I said, I know there's a lot of various actors around here, but just any support that you can give. We're going to be doing a public comment period. So just the more people that we can get involved in knowing that this is an alternative, I think the better, because it is starting to get buzz, and that's really been my main job. But at the end of the day, we just want this to be an accepted process, because I think within the climate community that I'm new to and I've been involved with now for 6 months, there's just a very negative connotation towards anything oil and gas related. And I keep telling people, like, well, if you really don't believe oil and gas demand is going to go down, this is all kind of a joke, because that's where almost all of our emissions come from. So if you really want to effectuate change, let's pick the lowest hanging fruit, and this is it.
I agree. I mean, the conversations I've had with people more members of the environmental left, I think at first they might balk at the idea of paying a producer to do something, but to your point, regardless of macro demand trends, to your point, these wells have produced a barrel of oil a day, no matter the commodity price. So I mean, these things are going there. It's, in my opinion, it's a no-brainer solution, and it's saving the taxpayer millions of dollars down the line. It's saving, it could be saving a water system from methane migration. There's a number of different aspects where there's a lot of positive right now, right then. And I think that in order to solve this and to address any of these issues, we're going to need some investment from industry. This is not going to be a blue versus red thing. It never will be, and won't be. I mean, just look at this morning, our presentation on the IOGCC and the implementation of funds there. So none of these issues are binary and clean. And I think this one speaks to that, and it makes sense to me. It's pragmatism at its best.
Thank you. Yeah, and I mean, it's everybody's problem. There's wells like this in almost every state in the union. So, and DC.
Precisely. Jeff and Sam, thank you very much. We really appreciate it.
Thank you.